when a lot of people first start, they really don't know who to work with as far as operators. And so the goal for left field investors and now with passive pockets is kind of that three-legged stool of investor networking, education, and access to high quality deals and operators.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is your host Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Ryan Stieg, who is a founder of Left Field Investors and a fund manager at InvestWise Collective. He has been investing since 2016 and has explored a wide range of asset classes with a portfolio spanning of 1 to 3 units, rentals across 6 US markets, and over 50 real estate syndication. Ryan is deeply experienced in passive cash flow focused investing. So Ryan, welcome to Decoding Cashflow. It's a pleasure having you on here.
Thank you. Thank you. I appreciate the invitation and look forward to the conversation.
Right. So before we go and discuss, your current niche and what you currently focused on, if you can give our listeners a little bit background about yourself, how did you get started in the real estate, and what do you do as of now?
Yeah. I guess my path to real estate is kind of wandering, and I know we'll talk about kind of the one book that started it, but it was a book that really started it. So kind of going all the way back when I finally got started in real estate, I became an accidental landlord. My wife and I had bought our first house. We moved, so I became an accidental landlord, and I wanted to stay in and get more invested in real estate. And I had heard about a concept called turnkey investing. So listening to podcasts and diving in and learning a little bit more about that, we pulled some savings and some money from a home equity line of credit and started to buy turnkey properties in Indiana and Tennessee and Missouri. And I got to a point where I really felt like I was working myself into a job, even though there were property managers that were working on them. To scale to the point that I wanted to was going to be a lot of work to take on. And so I realized that probably wasn't what I was going to scale at in real estate. And I had a full-time job, so I wasn't going to go out and flip or do anything like that. And so I'd heard about passive investing in real estate syndications. And so I dove deep into that idea. And in late 2017, I started making my first investments in real estate syndications and started with multifamily real estate syndication is kind of the where a lot of people hear about and get started. So that was kind of my wandering path to how I got into passive investments from buying our first property as a primary residence, and then through different iterations and learning experiences, I got to passive investing.
All right. So do you still own those properties that you had bought earlier, or you just liquidated everything and now you're totally passive?
No, I've learned now. We sold what was our primary residence. That was our first accidental landlord experience. I sold that at what now, looking back, was the wrong time in the market. So I don't like to look back at what that house is worth now. So I've learned my lesson not to sell, but I'm also not buying new directly owned real estate. So we sold one turnkey and then that previous primary residence, but I haven't sold any other real estate. So I'm holding it. I love the advantages of holding long-term fixed rate debt and the appreciation of what real estate does and the rental income that comes with it too. So I haven't sold any more, but I'm not scaling anymore either.
So now you're mainly focused on the passive investment side of the business, right? as you
Yes,
mentioned.
yes.
Okay.
Almost
And
exclusively passive investments now.
what are the different asset class you focus on during you mentioned multifamily. Is there anything additional, any other asset class that you focus on while investing passively?
Yeah, I really like to. I started and probably got real heavy into multifamily before I really opened my eyes to different asset classes. And so, as I've grown my portfolio, I really like to diversify across geographies, operators, and asset classes. So, to answer your question specifically about asset classes, I'm in several different asset classes: multifamily, self-storage, office, um, uh, triple net industrial, and several others. But though that's probably the most concentrated my portfolio is among those four asset classes, as well as notes.
Hmm. That's pretty interesting. Notes. That's not everybody does the notes. So if they are doing notes, they're mainly focused on notes. But yeah, that's a really good diversification within real estate, I would say, right? And I know how did you get started with the syndication? Like, as you mentioned earlier, right? It was too much a hassle to manage all these different properties, small multifamilies across different states. But what gave you an idea of starting to syndicate, or what is a pivotal moment, or what triggered that thought in the mind?
I can't pinpoint exactly what it
Hmm.
was, but when I first started in investing in turnkey real estate and then transitioning to passive, it was really podcasts.
Okay.
So interesting that we're having this conversation on a podcast, but it was really, I used podcasts as my what I'd listen to on my commute to work and commute home. And there was a guest on one podcast, and I can't pinpoint who it was, but talking uh, about syndications, and I thought, and that sounds a whole lot more scalable
Mhm.
than directly owned real estate. Now, I've learned too that passive is a little bit of a deceptive term because you need to do your due diligence and understand what you're investing in. But as
Yeah.
far as the operations go, you're passively involved.
Yeah.
But yeah, it was a podcast, probably in 2016, 2017, somewhere in there, podcast guests, and then I kind of dove deep into what passive investing through syndications meant.
Mhm. And as I mentioned earlier during your intro, right, you are the founder of Left Field Investor, and you're also fund manager at InvestWise. So if you can give a little bit, what are these two different roles about? Like, what do you do in which role? And
Yeah,
and you also mentioned, like, Left Field Investor merged into other firm. If you can give us a little bit background on how that happened, what was the transition period for that?
yeah, great question. And kind of as I look back, uh, there's a few different things that sparked the kind of the next step in my real estate career. So Left Field Investors is now Passive Pockets. We're a passive community under the Bigger Pockets brand. Um, but what started that was when I first started investing in real estate syndications. It was me and the podcast, and I didn't know
Okay.
anybody else who was investing in it. I didn't know anybody else locally who was investing. So after I made that first investment, I went to a real estate investor meetup that was centered around passive investing, and sparked a conversation with a guy named Jim Pfeiffer. And we were kind of in the same boat. We didn't really know anybody who was investing in syndications. And so when we left that conference, we decided to have a biweekly call every 2 weeks, just talking about real estate investing.
Mhm.
Like I said, neither of us really had a large network of people locally, so we just decided to have a phone call every 2 weeks. And at the time, he was starting to break from an active real estate group to start a passive real estate group in Columbus, Ohio.
Okay.
And so uh, that was in March of 2020. And
Mhm.
we all know what happened in March of 2020. So that
Yeah.
local real estate group never had a first meeting and they had to pivot to Zoom.
Hmm.
So Jim and I'm out in Montana, and Jim started a group in Ohio. So we just started Zoom meetings, and he invited me to one of the first group meetings for Zoom that was going to talk about passive investing. And at the time, we just found out that there was a larger network than just a small 5 or 10 person group of people that wanted to learn about that. And so uh, we it was kind of like I started as an accidental landlord. Left field investors started kind of as an accidental business
Mhm.
around just networking and growing a network of people and education around passive investing. And so that was in late 2020, and then earlier this year in August, um, we found a lot of synergy with Bigger Pockets and their desire to start a group called Passive Pockets. And so it just seemed like a natural marriage to have our passive investing group, Left Field Investors, work with and help launch Passive Pockets under the Bigger Pockets brand. So that's how that kind of journey went from just kind of starting a small networking group and then growing it into something that we could work with Bigger Pockets to carry on.
All right. So, what's your relationship now with Bigger Pockets, right? Are you part of the Bigger Pockets team as of now? Can we say that, or are you one of the member of the passive investor group?
Yeah, so I am in this transition. I'm a consultant with Passive Pockets. So
Okay.
the whole Left Field Investors team came over as consultants to Passive Pockets so that we can help launch that and make it a successful launch. So yes, I'm a member of the Bigger Pockets team as a part-time consultant
All right.
for Passive
So,
Pockets.
mhm. So let's maybe, before we get into the other aspect, I would like to understand about, starting this community, right? You said you started the left reading, now you're in the passive investor community. So if anyone wants to start a new community, right, and grow that community, what are the steps they need to take?
I wish I could answer that question really well, but it kind of happened to us rather than us forcing it. So
Yeah.
those first meetings were probably 10 or 15 people on a Zoom call. I mean, that was still when Zoom was brand new to most people. So the first 5 or 10 minutes of every meeting was who's on mute or who's not on mute, who can even figure out how to get their camera on. It was kind
Hmm.
of in Zoom's infancy for us anyway, for most people. And because we weren't bound by geographic boundaries, I'm in Montana, and most of the rest of the group was in Ohio. Um, it could grow a whole lot faster than what a traditional local meeting at a restaurant type real estate
Hmm.
group can grow from. So each of us, as we grew, or as we started joining the network, we just reached out to other people. And this was also kind of when syndications were really becoming popular. So there was a growing interest of people who were looking for alternatives to get out of the real or to get out of the stock market.
Hmm.
And there was just a natural interest in learning more about passive real estate through syndications. Most people were or are vaguely aware of buying a rental or flipping or something like that. That was their exposure to real estate. But when you're opened up a little bit to the world of passive syndications and investing either for cash flow or equity or a mix of both, there was just a general interest from the larger community to join a group where you can network with other investors. So I wish I could tell you, hey, this is the key to growing a community, but we were just kind of at the right place at the right time when there was a natural growing interest of how to get into alternative investing through real
Hmm.
estate.
And how frequently did you had these meetings, the virtual meetings?
The whole group meetings, we had intermittent meetings for different reasons, like
Okay.
lunch and learns and around different deals that we were looking at. But we had regular group meetings once a month.
Mhm. And what's the strategy right now as a part of the passive investment club, right? Under Bigger Pockets.
The strategy right now is still the same. We were always centered around networking with other investors, gaining education, and then having access to operators. So
Mhm.
When a lot of people first start, they really don't know who to work with as far as operators. And
Mhm.
so the goal for left field investors and now with passive pockets is kind of that three-legged stool of investor networking, education, and access to high quality deals and operators.
Mhm. All right. Now talking about the operators, right? Um, how do you like? Of course, sometimes you get referred by a friend or to an operator. Uh, but uh, as a part of this investment, you have to vet the operator very carefully, right? Or not only the operator, but the deals also that comes through. So what are your specific maybe thumb rules or main strategies that you can tell to our listeners to vet the operator as well as the deals that they bring to the market?
Yeah, I wish I could say there was a perfect science to it.
Hmm.
And over my experience in my portfolio, I've found that uh, the operator is still the biggest key to success. Uh, a good operator can make an okay deal work out,
Hmm.
but a bad operator can make a good deal bad also.
Yeah, that's true.
And so really it's uh, kind of the phrase is betting on the jockey, not the horse. So you do want to look at the deal specifically for uh, is the deal itself good? Is the market good? Is the economy there? Job growth? All of the factors that you'd want to know that. But you have to have a team that can execute the business plan.
Yeah.
And we a lot of us found in this last market cycle that kind of started with interest rates going up that some either plans or operators weren't built for success, and uh, some of those operators, some of those deals were kind of carried by the market and the market tailwinds that allowed okay deals to be good, but also uh, the strategy around debt. That was one thing that I just didn't understand all the intricacies of debt and how a team and a deal could navigate headwinds from an interest rate perspective. And so the biggest key is understanding a team that has a track record for success, that knows how to navigate different market cycles, and
Hmm.
can that deal withstand it. So there are some people who might be more acclimated to going into riskier deals, but you have to understand what you're getting into, and if
Yeah.
you're okay with the risk or if you're not okay with the risk. And so, one of the lessons I learned in this last market cycle is that uh, floating rate or bridge debt uh, was difficult in this interest rate environment where rates are increasing. And so
Yeah.
there were some deals that didn't perform well or stopped distributions. And you really see in a time like that who communicates well and who can navigate those challenges well. And so uh, I think new investors to the community now, or to new investors to this space, have the benefit now of hindsight being 2020. You
Mhm.
can look back at who navigated those challenges in the market well and who didn't. And uh, as with any market cycle, we're learning lessons kind of on the fly. And but at the end of the day, the key is to understand all of the documents and risks that are inherent in each deal, and with that operator. But really, at the end of the day, it's a track record of the operator. Can that team execute the business plan, regardless of the market cycle that we're in?
Okay. And maybe Ryan, if you can spend a few minutes on the typical deal structure that you bring to our investors.
Yeah, so you asked earlier about InvestWise Collective, and InvestWise Collective was spun up out of left field investors just to be
Mhm.
a little bit more focused in bringing specific deals vetted for a smaller group of people. And so, a couple of the things that we look at are deal structures that both are incentivized for the operator and the investor. It should be a win-win.
Yeah.
Um, and so we really look for and an operator that isn't so heavily incentivized by fees, and we want the incentives to be aligned throughout the deal. And so that's one thing we look at is is the general partner or the operator and the investor or the limited partner being adequately compensated for the risk they're taking and the work they're putting in. And so we try to solve for fee heavy deals where the operator wins on the front end, but doesn't really have incentive to carry it all the way through. And if it is carried all the way through to success, that everybody's rewarded properly. So really looking to make sure that incentives are aligned. And that can be accomplished through a couple different deal structures. But really at the end of the day, that you want everybody to be incentivized to have a successful deal from the purchase all the way through the sale of that asset, if it's a single asset. But in funds, it's the same way. You want the incentives of the general partner and the limited partner to have the same incentives aligned and to be rewarded adequately for their participation.
Okay. And when you mentioned this fund manager for InvestWise, right? Is it like one fund into which all the investors invest, and then you become the fund of the fund for the operator? Is that the structure you have?
Yeah, we're currently in a customizable fund. So
Okay.
our investors currently have the opportunity to invest through InvestWise Collective and choose their own investments. So it's not a fund where you're just kind of subject to anything and anything we want to invest in. It's structured as an investment club from a regulatory standpoint. So investors can invest through InvestWise, and then they have the ability to pick and choose of our offerings which ones they invest in. And we don't currently have any deals that we're the general partner on. We're basically a conduit for investors to find high quality deals, and we're the conduit to help them invest in those deals. So typically we will bring lower minimums or better returns to the investor than what they would get otherwise going direct.
Yeah. Because, absolutely, you have a good relationship with the operators, as well as you bringing the bulk of money through the group of investors. So they will offer you a better return if anyone goes individually.
Yes, absolutely. And I'm glad you brought that point up, because to our investors, we want to bring either lower minimums or better returns than going direct. And to the operator or general partner, we're providing value by bringing a higher check size through one check. Administering smaller investors is more labor intensive for the operator, and so that's the value that we're bringing is a consolidated single check in a larger amounts.
And based on your experience, right, you know how to better vet the deals than the individual investors who are coming just cold, or maybe who is just doing the first or second deal. So that gives them an extra layer of protection, I would say.
Yes, and we're obviously not perfect, and no one is, but we try to leverage the experience that we've had in vetting deals to network. So we're bringing value by networking with operators and sponsors to bring deals that are otherwise hard to find for retail investors. Google is not the best place to find your first passive investment. And so you want to leverage a network or a fund-to-fund sponsor like us to leverage our network in an additional layer. So we can never offer any certainty that the investment will go well, but it's an additional layer of vetting and underwriting a deal that typically the retail investor doesn't always go to that depth.
Okay. And Ryan, what are your main strategies to build and maintain the strong relationship with the investors? Like how do you create the funnel to bring in the more investors?
Well, we leverage the different networks that we have. So networks that we've built through left field investors and passive pockets, and one of our fund managers, Paul Shannon, was an operator and has his own deals that he has brought. So we're all kind of leveraging different networks and different circles that we've been in. And a lot of times, even though this is a passive investment, retail investors want to have an additional layer of vetting, as well as the benefits that we bring through either lower minimums or better returns. Everybody feels better with more eyes on the same deal. And so our goal is to bring education and transparency and a deeper level of underwriting to our investors, and hopefully that is a referral that they can make. And we've had some word of mouth referrals that people just like having the ability to have deals kind of sourced through them. We're all looking through. If you're looking to make an investment, you kind of have a top end funnel, all the deals that are out there that you're aware of, what fits your criteria and what doesn't, and then vetting that down to a level of the capital you have available and the deals that are available to you. And so we're just helping to provide that additional filtering as investors are looking for their next potential investment.
And any strategies that you implement to attract more investors?
Just leveraging our community and our relationships right now too. So some of those are personal relationships, and some of those are network relationships. But really, we want to build a foundation of trust first. So our strategy is not necessarily exponential growth through scaling and growing a larger community, but to build our investor trust in how we're underwriting. Does it align with how they underwrite? Does it align with their investor goals? Does it align with them as individuals for how we go through that process? So our strategy probably is not the same as others, because we're looking to create a solid relationship of trust with our investors, and that in turn will grow faster than going through some sort of mass advertising or marketing campaign. So we're looking to build slow and steady versus
organically, I would say.
Yes,
right?
organically more so. Yep.
All right. So, Ryan, you have been doing this for quite some time, right? So I'm pretty much sure you might have come across any tough situation or challenges during this period. Any one instance you would like to mention or tell to our listeners, which came any situation that was tough, challenging, and how did you come across that?
Yeah, I think a couple of the tough things that I've experienced just really circle around this last market cycle.
Okay.
In 2022 and 2022 prior, it seemed like everything was going right. The headwinds or the tailwinds were behind every operator. Values were increasing, rents were increasing, everything was going right until it didn't. And so a couple of things that were the telltale signs for me were a slowdown in communications or no communication at all. Nobody wants bad news, but I think everybody would prefer news and updates over no news at all. And so one particular instance that I can remember is a great communicator slowed down communications. Then there were no communications, and then there was a capital call, and then there was deals that were losing money. And so that transition, one, exposed me to the risk that I had taken on unknowingly, but two was seeing the kind of the true colors of that operator in tough and challenging situations. And the pivot wasn't quick. There was no necessarily plan B for what happens if interest rates spike on our floating rate debt, and what happens when rent growth doesn't go according to the pro forma that we had mapped out, or what happens when insurance costs and labor costs and construction costs in renovations increase. So one of the things that helped me look at is investor communication in good times and in bad, and the ability to have different exit strategies for different market cycles. Can that deal sustain itself? Can it cash flow when all of the pro forma projections don't go as planned. And so
Mhm.
the ability to pivot and then communicate in good times and in bad were really the key signs that I look for now going forward, and understanding all of the levers that can make a deal go good and bad in any particular deal.
Yeah. Yeah. It's always, uh, based on the different scenarios, right? You got to stress test the deal just to make sure that it passes all the stress tests, like interest rate spike, economic downfall, rate, any other circumstances.
Yeah, that's a great point, and that was the word I was looking for that I didn't say is stress test. And
Yeah.
I recently saw a pitch deck that had pages of stress tests
Mhm.
for rent growth assumptions, exit cap rate assumptions, expense assumptions. And so when you can kind of pull all those levers to see where the break even occupancy is and where the deal can still be successful if any of those projections don't hit, that's more comforting to me now to know all of the things that this deal can sustain and still be successful, or at least
Mhm.
preserve capital. So stress testing is huge.
Yeah. So, Ryan, now the interest rate is stabilized and now it's coming down, right? Maybe within the next couple of days, we might have 25 basis point more, um, uh, cut by Fed, right?
Yep.
Expected. Let's see what happens.
Yeah.
Uh, so what do you see? How do you see the landscape evolving in the next couple of years?
I think there's a couple things changing. There's a new administration.
Mhm.
There is interest rates stabilizing, and we don't know where they're going to go. Um, but I think there's a few things that are coming, especially specifically in multifamily. Rent growth has stabilized partially because of the economy, but also depending on the market, there's a glut of supply coming on, and so
Mhm.
in 25 and 26, I think one of the things in multifamily is the absorption rate of the new supply, but also because rates have spiked so much recently, the supply that wasn't already in the pipeline, there's going to be a lack of supply for the next couple of years because there weren't new projects started because they didn't pencil. And
Mhm.
so I think there's a couple different dynamics that are working in all different asset classes, but specific to multifamily, I think there is a wave of supply and demand that is kind of evening out in 25 and 26, and we'll see how that plays out. Um, Interest rates will certainly be a factor. Every time that there's an interest rate cut, there's a new there's a new margin in some of those deals that didn't pencil previously that may now. So one thing I'm trying to keep an eye on is making sure that any new wave of deals that come after an interest rate cut, and I know that that doesn't work, in direct correlation, but um, if there's a new wave of deals that now pencil, it makes me a little bit nervous as to whether there's a margin of safety in there or not. If
Mhm.
if a 25 basis point cut makes the deal work or not,
Got it.
it doesn't give me an incredible comfort level that there's a margin for safety in there. So I'm kind of rambling with my answer here, but I think there's several factors that are going into the next couple of years. Interest rates and what happens with each asset class's cap rates. Cap
Mhm.
rate compression helps that, and interest rates coming down also help new deals pencil. So those are kind of tailwinds that help make the market look good. And then also the dynamics of supply and demand specific to multifamily that will play out over these next couple of years will impact rent growth, will impact supply and demand. So I think I don't know that I have a crystal ball that will tell us what will happen, but I think we're heading into something that is a lot more compelling for new investments than it has been since rates started to go up.
Okay. That's absolutely right. Yeah, let's see what happens, right? Maybe as the rates decreases, you'll also see the cap rate moving down, because they got to keep that spread, right, between the rates and the cap rate. Uh, so let's see how it plays out. Well, maybe, there might be better deals out there that might come across.
Yeah, and I think that that's a really good point. While we'll assume that cap rate compression will help values,
Mhm.
I think that that's one thing that I would watch for is the exit cap rate assumption on new deals,
Mm.
because if we're assuming cap rates will compress significantly, that makes the assumptions in how the deal will perform. It magnifies those, and so I think you want to watch that it's a conservative estimate on cap rate assumptions, and that we're not assuming that they'll compress so far that it makes a deal pencil that otherwise wouldn't, if that makes sense. So I think you want to
Yeah.
watch assumptions on the exit cap rate, even though I think we can all assume that they will continue to compress. I think that that's something to watch. So
Mhm. Yeah, absolutely. All right. Hey, Ryan, loving this conversation, but want to be mindful of your time also. So we'd like to move to the final round of questions. Are you ready?
yeah, I think so.
All
Let's
right.
go.
Okay. All right. So the first one, which is the one book that had the most impact on your life or on your business?
Um, on the biggest impact, the book that had the biggest impact on this conversation is certainly Rich Dad Poor Dad. I think it's probably the book
Hmm.
that everybody refers to, so it's not a
Yeah.
new answer. But although that book doesn't have necessarily specific actionable advice, it shifts the mindset. And that's what started my whole journey in real estate, is that shift in mindset for what that book teaches. And so
Mhm.
um, it that kind of started the the iterations of how my real estate journey would kind of evolve. But it all started with that shift in mindset for real estate and what it can do for you. So that would be the one I'd pinpoint for my real estate career.
All right. What are your main source of information to learn and grow?
Um, I'd love to say I have one, but I don't. And I think that certainly one that I utilize is Passive Pockets. I think there's a
Okay.
community of investors there. There's a forum that's active, where people can have conversations. You're having real conversations, and everybody is kind of synthesizing what they see and hear in the news and what's going on with their deals. And those conversations kind of filter out um, what's going on in the real world and how it's impacting people. So I like to keep up with the forums on Passive Pockets. And then I like to use my network to within and outside of that, just to get a sense of what everybody's seeing and hearing in the news and what's happening in real time. Uh, but uh, but I don't have a single source of new information. I kind of just try to like filter out everything that I have access to see how I'll form my opinions.
All right. And what is the best business or investment advice you'd like to give to our listeners?
Um, I think for me it has been taking forward action. Um, I think that at times in my life I've kind of fallen prey to paralysis analysis and
Mhm.
really finding what the next best step is. But as I look back at how my real estate career has evolved, it has always come down to identifying my next goals in my career and taking action toward them. And whether that was reading a different book or making an investment or talking to an operator or meeting a new investor, that always started the next iteration of. So as we look back on our conversation, I was an accidental landlord, and then I wanted to invest in turnkey properties, and then I wanted to invest in passive syndications, and then I met Jim at a conference. And so I think my best advice is to look at your future goals and take some action.
Yeah.
Taking action will open up the next door and open up the next steps for you. So having your goals and taking some action toward them will give you forward momentum uh, toward those goals.
Yeah. Don't try to be perfect. Like you don't try to be like 100%, like I got knowledge of everything. Don't try to be at
Yeah.
that point. There's nothing called 100% complete. You got to take a leap of faith, dive deep into it, and you'll learn how to swim.
Exactly.
Yeah.
Couldn't have said it better. Yes. If you're waiting for 100% certainty that that next step is the right one,
Yeah.
you'll never take action.
Yeah. Exactly. All right. So which is the one habit or routine which has been crucial to your success?
I think for me now, other than taking action, is really trying to time block for myself.
Okay.
I'm involved in a few different things, and I've got a personal portfolio of rentals. And I think that setting goals and setting time aside to take actionable steps forward, uh, I really started to be more intentional about that in 2024 to time block and make actionable steps that I need to complete, prioritizing my
Mm-hmm.
activities.
Okay.
And then recently I was introduced to the 12-week year, uh, really taking 12-month goals and refining them down to 12 weeks. So you're taking actionable steps faster. And
Mm-hmm.
so that's what I'm looking to implement in 2025 is to implement that 12-week year so that I can identify my goals and take actionable steps forward in each of those goals uh, a week at a time as opposed to a month at a time. So those are just some of the things that I'm working on right now.
All right. That's pretty interesting, way to plan your goals.
Yeah.
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 So, all right. Ryan, last question. How can Decoding Cash Flow listeners get in touch with you?
A couple different places. LinkedIn. I'm on LinkedIn, and I'm not super active posting, but I have made a lot of connections through LinkedIn. And then you can find me at InvestWiseCollective.com or on Passive Pockets.
All right, Ryan. It was a pleasure talking to you, and we'll
Likewise.
surely stay in touch.
Yes, I appreciate the invitation and the conversation.
All right. Thanks a lot for
Thanks,
coming
Ed.
on the show.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.